Well, with tax season now underway, there are new reporting requirements to be aware of if you have something called a bare trust. To learn all about it and the implications, we're joined by Ali Spinner. She's a tax partner at Crowe Soberman LLP. Ali, thank you so much for joining us. What's a bare trust, and what do our viewers perhaps need to understand about them?
That's a great question. A bare trust is effectively when one person or one entity owns title to an asset in beneficial ownership for someone else. So a bare trust relationship can occur when the legal title holder and the beneficial owner of the asset are not the same person. Somebody holds something in trust and takes care of it for someone else.
And do I understand correctly that until now, if you were involved in a bare trust, you did not have to, there were no tax implications directly to you?
Correct. And until now, there was no filing requirement required with the Canada Revenue Agency. As part of changes that have been made and have been made for a while but are finally coming into effect for bare trusts for the year December 31st, 2023, they will have to file a T3 trust information and tax return and file it by April 2nd, 2024. This will be the first time. And
do they get a T3 issued to them by another entity?
It's a great question, and this is part of the big confusion relating to bare trust. No, so a bare trust really is in respect of the ownership of the item, the title, I should say, of the item. They are not the beneficial owner of the item, meaning that the income that is reported from the entity doesn't actually show up on the return.
Right.
So the conundrum is that a tax return has to be filed, but generally, I think in almost all cases, there will actually not be any income or tax on the trust return itself.
But there will be a cost to that, I would assume, correct?
There absolutely is a cost to it. And one of the interesting things is that these trust tax returns are not necessarily easy to file. A lay person, a lay taxpayer who is wanting to file this for themselves may have difficulty. I completely understand that the CRA would like more transparency, and Finance, when they wrote the legislation, they're looking for more information about who really owns assets. Right. If assets are held by one person, who's really the beneficial owner? The interesting point, though, although there will be costs associated with the filing, in many bare trust tax returns, we'll be telling the government who the trustee is, who the beneficial owner is. We won't actually be telling them what the asset is on that trust tax return. There will be cost. There'll be a lot of time spent by accountants. I'm not sure that the government is going to get the information they're looking for from all of these filings.
What kind of quantum, in terms of these bare trusts, like in terms of how many tax filings you would have per year for your practice, let's say, would it be another 10%, 5%?
Oh, that's a great question. We're actually trying to figure that out right now. Given that this is a situation where the first time, we're actively working with our clients right now, trying to find all of the bare trust relationships. There will be many, hundreds of thousands, millions in Canada. I'm not sure of the number, but a couple of examples of bare trust relationships, which would probably be helpful. For example, in trust accounts in investment houses. So if a parent or a grandparent holds an in-trust investment account for a child, if there are certain assets held by that investment account, or if the investment account is a certain size, that's a bare trust. For example, in the real estate community, it's very common to have title held by a bare trustee corporation in bare trust for a different entity as a beneficial owner, whether for liability protection reasons, purposes, or privacy reasons. Those are all bare trusts. If a person is added to an elderly parent's investment accounts or bank accounts in title only for purposes of ease of administering their elderly parent's investments or bank accounts, that's a bare trust where that person has added themselves to title. So it's a challenge because we're not sure how many are out there. We know that there's lots, but we're going through each of our client lists to determine, speaking with our clients to determine who has a bare trust, who has to report, and make sure we get it done by the April 2nd due date.
So it sounds like many taxpayers may not know clearly whether they have a bare trust or not. I mean, it's not a case of them looking for the phrase bare trust in their documents, correct?
Absolutely, absolutely. Right. And in many cases, a bare trust document doesn't actually exist. You don't need an actual trust deed or trust document to create a bare trust. It's merely that relationship where the trustee is the agent or acting for the beneficial owner's interest. So it's going to be a challenge.
Okay, there's other things to talk about as well here. There are additional disclosure requirements for something called express trusts.
Yes. Absolutely. So as part of this plan for the government to get access to more information, the government is requiring, I would say, typical trusts, a trust that you would always have filed a tax return for. We now have to provide a lot of detailed information to the government with respect to who settled the trust, all of the trustees of the trust, and all of the beneficiaries of the trust. So we have to provide, for example, in a trust, the names, dates of birth, social insurance numbers of all of the trustees if they're individuals, but not just the trustees who actually receive money. We have to provide this information for any contingent beneficiary, any possible beneficiary, even if the trust is fully discretionary. So that's going to be an interesting challenge as well.
I think Ryan asked a similar question, but what do these changes mean to your industry, and what does it mean to the CRA itself? It's receiving a lot of new incoming information.
Let's talk about the CRA. I think the CRA is going to be bombarded either with new filings with respect to the bear trusts that haven't filed, or a tremendous amount of information about the ownership, about the beneficial ownership of assets with respect to who the beneficiaries are of trust. There's going to be a tremendous amount of information. I'm not sure how they're going to process it. With respect to how it's going to impact the accounting industry, it's requiring a lot of time from accountants to help their clients understand, and in many cases, help their clients, the trustees of trusts, go out and find the information that's necessary for the disclosure information.
Okay, well, you need to get back to your office.
Yes, I do.
So thank you so much for joining us.
Thank you.
It is an everything must go kind of day on the markets. We're seeing a pretty sharp pullback on a broad base of stocks. We're also seeing weakness in the bond market as well. The catalyst, of course, was inflation in the U.S. coming in hotter than expected. While it is cooling on a headline basis, it does show that the road could be a little bit longer than the market had anticipated with respect to getting inflation down. Year-over-year inflation at 3.1%. That is below where it was before, but a little bit hotter, as I mentioned, than expected. This one-year chart kind of tells us that we are doing the work, even as that work is slowing. Nevertheless, the market totally got rid of rate cuts for the month of March and basically for May as well. And we're seeing that kind of repricing happen in the markets right now. Young-Yu Ma is the Chief Investment Officer at BMO Wealth Management in the U.S., and he joins me now. I mean, we got used to, right? Weeks after week after week, you just get nothing but 1% moves to the upside. Maybe it's not so surprising, regardless of what the catalyst is, that we get a little bit of a pullback.
Yeah, thanks, Amber. It's great to be here. It's not so surprising, but the data that came out this morning definitely sent a jolt through the markets and really awakened the markets to the idea that we might not be on this Goldilocks type path, and that the Fed's interest rate cutting program might be pushed out much further than expected and come in much more gradually than expected. So I do think this is somewhat of a wake-up call for the markets here, and the grind higher that we've had since the beginning of the year is probably on hold for a while, and we're expecting some choppy markets going forward here.
So it sounds like it's prompting a rethink, not only for investors, but for you as well, in terms of how you thought the year might play out.
Well, I think for every 1 month of difficult inflation data that you have, you probably need about 3 months of good data to get the Fed back on track to thinking it's going to be focused on cutting rates rather than keeping them where they are now. So this inflation data that came in, even though it's backward looking, did have some very difficult components. There were multiple components, relatively broad-based, that showed inflation pressures elevating from the prior month on a month-over-month basis, and just far above what the Fed's target is if you project out that 1 month reading that we got in January. So I think this does cause some concern in the markets, and it's going to take more data going forward on inflation that comes in favorably to really shift the thinking back to where it was just earlier, just last week or in the prior weeks.
You know, we got to this point in the rally, though, with interest rates at 5%. And I understand that tech has done a lot of the work, but earnings broadly are also coming in better than expected. Do the markets need these rate cuts to continue advancing?
Well, earnings have been coming in pretty well, so that has been a pleasant surprise. The forward guidance is not bad as well, so I think that has also helped to prop up the markets. But certainly the markets have been focused on the idea that interest rates are going to be cut relatively soon, and that trajectory was going to be one that was more favorable than probably people are anticipating now, given those rate cut expectations are pushed out. Does the market need interest rate cuts is a good question. I think that we want to consider where valuations are now. And with valuations being relatively high, I would say that some of the market support is based on interest rates coming down later in the year and coming down to a meaningful degree. So to the extent that those valuations are high, we can still, I think, have a healthy market or at least a stable market. But to really see advances from here, I do think we need probably lower interest rates still to come down by mid-year.
This might be an inflammatory question, but what if we don't get any rate cuts? I mean, what probability do you assign to that? Is it higher today than it was yesterday because of today's rate of inflation?
Well, it's definitely higher today. If we get another couple of prints like we had today, I think that becomes a very realistic scenario. Now, the favorable news is that a lot of the forward-looking indicators that we track for inflation still show inflation coming down. We do still expect it to come down on perhaps a bumpy trajectory, but still come down over the course of this year. Although wage pressures are still a little bit higher than they should be and probably contributing somewhat to those inflationary pressures. But what probability we assign of no cuts this year? I think there are two scenarios where we get no cuts. One is inflation is just too high, and that's today's print points to that at least as being a possibility. We don't think that's odds on, but another possibility is that the economy just runs hot and the labor market stays very strong, growth in the U.S. stays very strong, and the Fed decides to keep rates about where they are, maybe cutting once or twice rather than the 3 or 4 or 5 times that the market had been expecting. And that could be something as well where the Fed just doesn't meet the market's expectations. But in terms of no cuts, we think that's relatively unlikely still, maybe only a 20% scenario of getting no cuts this year.
Okay, so let's put this all into practice, what it means for your portfolio. We'll tie it up in a bow here. You're looking for maybe a little bit more volatility, more chop, risks that the number of rate cuts are going to be fewer than maybe the market had been hoping for. So where do you want to be in the market in that environment to ride through that?
Well, I think the first consideration, we're seeing this play out today, is that in terms of fixed income exposure and interest rate exposure, you want to be relatively short duration. I don't think that it pays to be long duration here. I think that the risk you're taking from being long duration is greater than the potential benefits you get from being long duration. And although the risks are always a bit two-sided, I think right now those risks are skewed to higher rates rather than lower rates if you're talking about where the tail risk lies. So I think that's one thing in terms of protecting a portfolio that investors can think about, relatively short duration. I do still think that U.S. equities are still a stable place to be. We think that the environment will still be healthy this year. We do think that it's reasonably likely that although we had this difficult inflation print, the trajectory still stays downward for the remainder of the year, perhaps bumpy, but still downward. But we're going to need to see more favorable inflation data prints to be more confident about that and for the Fed to be more confident about that. But right now, we're not shying away from risk. We still think a balanced approach to the markets makes sense. We still like certain sectors in U.S. equities, such as infrastructure, technology as well. Biotech is having a difficult day because of rates going up, but we think by year end, biotech will also see better prospects.
Let's talk about tech, because sometimes talking about the market and talking about tech are the same things because of just how influential it is. But does that also present a downside risk? If there's any vulnerability there in that group of stocks, that is a vulnerability for the broad markets as well.
It definitely is, but I do think a lot of trends are going in the favor of the technology spend that's going to benefit those companies. So those trends are pretty strong here, and we don't think we're in the type of exuberant days that we saw in the late 1990s where a lot of these stocks became sort of unhinged from reality. The stocks that really are seeing the major benefits right now, yes, they are mega cap names. Yes, they have a very disproportionate weight in the indices and at least have the potential, if there are meaningful stumbles, to bring down the overall index levels. But we do think the trends are quite strong there. So it does present a risk. It does present a reality that it's an allocation that's hard to avoid. And it's a risk, and that's also difficult to avoid because we do think the trends very much play into the favor of some of those mega cap names. But certainly that's the nature of the market we face now. It's just very lopsided into technology these days.
I want to, before I let you go, I want to ask about regionals, especially on a day where we're seeing such movement in the bond market. How concerned are you about a repeat or worse of what happened last year with Silicon Valley Bank?
Well, we did see some strains. New York Community Bank announced a major write-down based on commercial real estate loans. We do think there are other banks to come that are in a similar position in terms of their regional and small banks having more real estate, specifically office exposure, than their books can easily write down, and they perhaps are not being fully reflected in the market right now. We do think that is something that could cause some hiccups down the line here, but we don't think it's a systemic issue. We don't think it's a large enough issue to bring down or to strain the overall financial sector. We think it's very isolated to some small and some regional banks that have overextended their loan portfolios at this time. So we don't think it's likely to cause the type of disruption in the markets that it did in March of last year. We think we could see some repeats like we saw a few weeks ago with New York Community Bank Corp of causing concern, but not enough to really cause a large downdraft in the markets.
All right. Thank you so much for your time today, especially on a day where a lot of viewers are probably tuning in to find out what's happening with their portfolio. So we appreciate your advice. That's Youngyu Ma, Chief Investment Officer at BMO Wealth Management.
Welcome back to The Open, and welcome to a special half hour here on the program. This week, if you've been watching, we've been leaning into the theme of love. Happy Valentine's Day, by the way. Specifically, stocks that some of our guests love. And we had spoken with Ms. Schneider and Joanne Feeney about some of their short-term buys and long-term holds and stocks they wish they had bought, but maybe they missed the chance. And we changed the wording around those to, in other words, be the stocks they date or marry or the ones that got away. And today we're broadening that discussion with a panel of experts to talk about their picks. Joining us here in studio, Brianne Gardner, Senior Wealth Manager at Velocity Investment Partners, David Burrows, President and Chief Investment Strategist at Barometer Capital Management, and Laura Lau, CIO at Brompton Group. Happy Valentine's Day, and thank you all for being here. It's great to have you with us, and our audience loves all of you, so I'm sure they're going to love this segment. But I guess when it comes to cashing in on stocks that you love, it'd be great to get some top advice from all of you. Laura, can I start with you? What's sort of the shining light to think about on that very subject?
I think the stocks that you love, long-term holds, that they are preferably a monopoly or a duopoly. They have pricing power, they have innovation, and you can sleep at night.
Right.
And there's not a lot of stocks that can do that, actually.
That can give you that peaceful rest. Yeah. Brianne, what about for you? Sort of similar philosophy or?
Yeah, I think similar to Laura. I think companies that have good profitability, we look a lot at where we are in the business cycle to depend on, what are those long-term stocks and stocks that we do want to continue to hold. If we can hold the stock forever, we will. If we want to trim it along the way, we will as well. But ultimately, we look at, fundamentals of that business, cash flow, strong management from behind the scenes. But again, as long as you can sleep at night, those are the stocks you want to hold.
I mean, I always heard Warren Buffett talking about names that he wasn't thinking about selling at some point. He seems to want to be committed to those stocks over the long term. This would make sense, I guess. David, from your vantage point, how do you think about this subject?
We're ultimately always looking for companies that we consider to be good to begin with, but are getting better. So ultimately, we love to see companies that the world sees in one light, but things are changing and they could get revalued to a higher level. Now, we do try not to fall in love. So we are sellers. But ultimately, you're trying to find really high quality companies in areas of the market that are going through some kind of structural change that benefits them for an extended period of time.
But this does get into another dynamic of the markets. I mean, to David's point, Laura, you can buy, you can sell, you can do it all literally in the next 10 minutes if you want. But I guess as an investor, the value of long-term investing is if you pick the right names that let you sleep at night, that's part of the equation?
Yes, that's definitely part of the equation, but I think also you have, as David said, you got to be pragmatic as well. You can't always fall in love because sometimes things change, and the stock you love so much, they may not have been able to keep up that innovation may not be there, or it's become too large of a weight that for risk management purposes, you do have to trim.
I feel like you might have had at least one sleepless night based on what one company might have said over the years. That's maybe a story for another day. But let's get into some of these specific ideas for investments. And, you know, a lot of people going on dates for Valentine's Day. So we're going to start with this idea of names that you might be interested in, might not necessarily be the long-term play. Brianne, I'll start with you. Is there a name that would sort of fit that mold for you?
Yeah, I think thinking about a stock that we want to date. So, you know, maybe we're like dipping our foot in, we're not too committed longer term. We see a tactical trade opportunity. For us, that is Granite REIT. Okay. So the Canadian residential or real estate investment trust company that focus on industrial and logistics space pays a great stable 4.4% dividend. I think, too, the real estate sector, I mean, has negative year to date and hasn't really done well over the past 2 years. But we see stability in the industrial space, and we think Granite REIT is going to participate that. Also on the background of interest rates coming down this year and potential and next year as well, we see that Granite REIT will participate and real estate will participate in that as well. So interest rates coming down reduces the debt payment that these companies have to pay, which also ultimately leaves them with more cash flow and profitability in their pockets and allows them to expand and grow their portfolio. So it ranks 8 out of 10 for us over the past 5 years, has annualized about 8.8%, and potential upside from analysts on the street is about 18%.
So it's not necessarily that there's uncertainty in the future, it's that there's opportunity today.
Yeah, I see it is a stock that we own and we want to continue to own. But, you know, I think 2024 could be the year you maybe serial date. And there are a lot of opportunities out there outside of the Magnificent Seven. Okay.
On this same subject, David Burrows, what would be the kind of stock that might fit the dating aspect of investing?
Yeah. So, you know, when we look at the world for dating, there are lots of companies in industries that are a little more cyclical, right? So there's a time to own them and there's a time not to own them. Now, you know, we're looking at the energy sector as one that has, you know, consolidated over the last while. Seasonally, we're getting to a period where it gets a little bit better. I mean, if we look really from the beginning of the bear market in the S&P, the energy sector in Canada is actually up about 40%, but it has retrenched recently. And, you know, some of the companies with really long life assets are kind of interesting. So I look at Suncor as one that we would be interested in because it's got really long life assets. It pays a great dividend. So it could start as a date. You got to take a little risk. It could turn into a long-term relationship. They've done a good job in paying down debt. There's activist shareholders involved trying to unearth a little bit of value. And so this one could pay dividends going forward.
Okay, so an energy pick in Suncor. Brianne talked about a real estate play. And Laura, you've got a technology idea when it comes to a stock you might date.
So I think that, you know, when you think about the dating pool is very big. Most of the stocks actually fit in that dating pool, especially in Canada, because we have a lot of deep cyclical stocks. It's energy, materials, mining, and then a lot of those stocks are, in Canada, we are a cyclical economy. So even the banks are cyclical. So I think that in Canada, a lot of stocks you do date. So the time to own deep cyclicals are the worst. They don't make money. So what we had last year for technology is, in general in the US, the most cyclical part of the economy is semiconductors. So you date the semiconductors, and within semiconductors, the most cyclical is actually memory chips. So memory chips were down 50% last year in terms of prices. So this is the time to buy them because now we're getting some cyclical headwinds. Tailwinds. PCs, people are buying PCs after COVID. We're seeing all these companies starting to build AI data centers, again, very strong for memory. So we're going to have more AI content in phones, PCs, and data centers. So that's very strong for memory chips. So we've picked in this space Micron. And Micron has also, on top of that, won more contracts with NVIDIA, which is the AI darling, in their new AI chips, because some of the new chips have better energy performance and better performance, period.
All right. This is great insight. At the very least, we can give all sorts of information for people to sound smart on their Valentine's Day dates, but certainly some stock ideas for our guests watching at home today. We're going to take a quick break, but the panel is going to stay with us, and we're going to talk about the kinds of stocks that might be a good long-term play. We'll be right back.
Let's talk battery materials. A company based in Quebec called Nouveau Monde Graphite said it has signed deals to supply both Panasonic and General Motors with thousands of tons of raw material to make batteries. And both of those companies will take an equity stake in Nouveau Monde worth $25 million each. Nouveau Monde, for its part, is working on a $1.2 billion CapEx plan. We're joined by Eric Desaulniers, founder, president, and chief executive officer. Thanks very much for coming on the show.
Thanks for having me, Andrew.
Most of us hadn't heard anything or much about Nouveau Monde Graphite before today. You're certainly on the map. So do you have a mine in Quebec right now? Can you start off with that?
Sure, we have the two most advanced mining project in graphite in North America. The first that we're developing, and it's the discussion today, it's the Matawini mine located 2 hours north of Montreal that we're developing since discovery in 2014. And the second one is the Watnan mining project that we have acquired two weeks ago from our colleagues at Mason Graphite to be our growth phase following the one that we're talking today.
Right, and Mason Graphite, I think, is a shareholder in the company. Now, you are planning some pretty aggressive spending. You're working on the mining, but then also a refining facility for the production of so-called active anode material. So that's another thing you want to build?
Yes, for sure. To be successful in graphite in North America, you need to build a full vertical. By only building the mine's not enough. Mm-hmm. The customers are looking for a very specific product, so you need to refine it into active material. That's what we're doing already. We've already spent in our phase one around $200 million in building this full vertical. So we have a demonstration plant already running, and that's the foundation of being able to attract such customers like Panasonic and GM. You need to have some sort of expertise. We have about 110 employees, and we're at it since many years already. And that's the foundation to finance the Matawini mine, along with the Bécancour transformation plant that we are talking about today.
And that would go into Bécancour, which is emerging as an electric vehicle technology center.
Yes, so we were the first of this battery valley to acquire our land in 2019. Mm-hmm. So indeed, most of the production of the 100,000 ton per annum of concentrate we'll produce from the Matawini mine will be going into Bécancour to be transformed into about 42,000 ton of anode material. And today we are announcing 36,000 ton of this future production is being allocated to two of the largest customers in the world, in Panasonic and in GM. So there's only 15% remaining available on our plant, but that's enough commitment long-term for financing our project.
Your market cap about $260 million. The stock down about 50% in the past year, though. Is that partly because people are worried about how rapid the growth in electric vehicles will be?
I think the general trend into battery space was down in the last 12 months. There's a trend in China. 100% of our competition today is in China, mm-hmm. and the product for graphite was down in the last year. So I think more and more the customers understand that if they want this EV transition to be successful in North America, they need to get involved into a project like ours. So today is a great milestone for that. It's a clear statement from largest player in this industry that they believe in the long-term commitment in EV. They believe into their long vision, their long-term strategy, mm-hmm. and they share and they want to get involved in projects that share the same values.
And you say that only Chinese companies are suppliers of this material right now?
today is the most controlled battery materials of all is the graphite. So it's 2/3 of the concentrate is produced within China, and nearly 100% of the natural anode material comes from China today. So since December 1st, it was a big day where China were told the world that there will be restriction to export this graphite outside China in the future. At the same day that the U.S. said, as a foreign entity of concern, China is not welcome in the supply chain, and any players using Chinese components or Chinese raw material will be restricted into the Inflation Reduction Act incentive package. So that's why you see more and more companies like understanding that they need to diversify, they need to find alternative. And what Nouveau Monde is providing them is a clear alternative into having a carbon neutral product, a resilient cost structure, and security of supply right here in their backyard, where they are now building massive battery plant.
Now, Eric, you said something a minute ago, and I didn't quite follow it. You said that in this plant you'll have some spare capacity, I believe, and that relates to your financing plans. Can you repeat that?
Yeah. So what we announced today is like 18,000 tons going to Panasonic for 7 years post production, and 18,000 tons going to GM for 6 years post production, meaning there's a 6,000 ton available still on our plant. But that's enough floating material to be able to finance the project with senior debt with the current offtake that we have, and that's what we'll be working hard in the next few months is to make sure we finance this project and get it going, and also continuing the conversation with the handful of other significant customers that are looking for this graphite for their EV transition strategy.
And sorry, the Bloomberg, our partners at Bloomberg reporting that you may go looking for about $475 million in equity. What would your time frame be for that?
But what we announced today is a tranche one, where both customers invest $25 million US each. However, what is also important is they commit for the second tranche for this project financing another $275 million US. So alongside the different governmental support, the different shareholder we have already, we have also Palinger's long-term shareholder. We have Investissement Québec here as a long-term shareholder. Along also all the conversation we have with lenders. So we're pretty confident that the interest is there. We have availability of the money to proceed with project financing, but we needed those offtakes, as a foundation to talk about senior debt financing.
Thank you very much indeed. That's Eric Desaulniers, is founder, president, and chief executive officer at Nouveau Monde Graphite.
Okay, one of the stock stories we'll be tracking today, Agnico Eagle. Now, the shares have been higher in the pre-market this morning, currently up close to 2%. The company's latest quarterly results topped estimates. Beyond the earnings report, Agnico has been active when it comes to M&A. It's a long-time part of the strategy there. An investment, for example, recently in Canada Nickel Company, part of its early-stage investment initiative. Ammar Al-Jundi is the president and CEO of Agnico Eagle. He joins us here in studio. Nice to see you.
Nice to see you again, John.
Okay, we kind of start a lot of these earnings conversations around just getting a better sense of what's happening in different industries. So in yours, how would you characterize what's happening right now?
I'd say our industry is a mixed bag. You're getting volatility. It's self-evident. You look at what's out there. What really differentiates us and what we've been able to deliver and continue to deliver is stability, quality, predictability, and we're quite proud of that.
And so in terms of what you can control, it's kind of an environment where people are obviously looking to grow, but they're also looking to control what they can control. How does that impact how you run the business?
Well, one of the big advantages we have, John, is we are regional players. We don't try to go everywhere in the world and learn as we go. We focus on regions where we know there's mineral in the ground, and we know there's the political stability to allow us to operate. And so in the Abitibi, where we've been operating for over 65 years, we have a better idea and are able to manage things with a little more predictability.
Now, just to further clarify on that, you obviously operate here. I believe you operate in Australia, in Finland, and Mexico, which I'm generalizing here, but these seem like pretty predictable markets just in terms of the the political realities in your industry. Sometimes to grow, you have to go to parts of the world that might be seen as more politically lacking in stability. How are you thinking about that over the longer term?
Well, I think it makes sense for some companies. We have a strategy that doesn't do that, but I'm not knocking the people who have a strategy that says, they might be willing to go to more difficult places. What I would say, though, is, one of the first things you learn in finance, even in high school, is risk-adjusted rewards, risk-adjusted returns. And so I think that's important. We have had good returns. I mean, you've seen our numbers, record across the board. But more important, in safe jurisdictions, predictable, and frankly, a very good future going forward.
One of the variables that is more out of your control is what the mood in the market is for something like gold. Yep. We were asking the CEO, Barrick, about his outlook earlier this week as well. How do you think about building the business around where gold goes? There's constant conversation. We've had some people making a very strong long-term case for gold, but even when you look at the one-year chart, as anything, you see a lot of ups and downs. So what's your perspective?
I am bullish long-term. I don't know where gold's going to be next week or next month or next year, but long-term I'm bullish. Data point, I got in this industry in 1999, gold was $250. People forget that. It's in that period of time, it's outperformed virtually every equity index in the world. So what I would say is I'm bullish on gold, but who knows what's going to happen in a very short period of time.
And then we mentioned investing in nickel as well. Yeah. Walk us through the strategy thinking there.
Sure. So Canada Nickel is a large land package, large asset, low grade. And so really, it's an option on nickel in our backyard. It's a very early stage investment. But let me say something about that, if I may.
Okay.
This country, we have a critical metals strategy. But John, you're not going to have any critical metals if you don't have miners. And let me give you 4 data points to think about. You got Falconbridge, Inco, Noranda, Alcan. These are all, I'm 59 years old. When I was a kid, those were international, global, Canadian champions. All of them are gone. So my message to the audience and to the Canadian government, you're not going to have a successful critical metals strategy without a successful mining industry.
And are you concerned about government policy around operating Canadian independent companies when you say something like that?
I think if you're looking at developing the critical metals and any metals, including the gold space and the nickel space and the copper space, you have to have an environment where, for example, it doesn't take 8 or 10 years to get a permit. Right? You need to have an environment where there is infrastructure, there's power, there are ports, there's ability to do things. I mean, if you look at Nunavut, the mining industry is 50% of the GDP. We alone are 30% of the GDP. We've built more roads in Nunavut than the government has. So, this country has fantastic natural resources, fantastic human resources, and we should position to take advantage of that.
And I guess if we don't, there are mining companies. I mean, to your point, we've seen consolidation. We covered extensively what was happening with Teck Resources. You have shareholders as well. You have to make a decision in terms of where a company goes that factors in all the stakeholders. And I guess sort of going back to your initial point, creating an environment that is business friendly to go along with that long-term strategy of leveraging what we can offer to the economy?
Exactly. Canada is the best place in the world to mine. We have the resources, we have the people, we have the geology, and we have good government policies, but they can be a lot better, especially now with the importance of minerals going forward.
Okay, let's go a little deeper into broader M&A for you. I mean, let's say hypothetically you're in a position to be an even bigger player in this market, given how you feel. How are you thinking about the size and scale of the company longer term?
We never think about absolute size. We think about how to create value per share.
Okay.
And so as I mentioned, we have a regional strategy.
Yep.
And so what we're always doing is we're always looking at what's out there. We like to invest, John, based on knowledge. And again, being in a region we produce more gold in Canada than the next 8 companies combined. So we're always looking at opportunities to create value for the shareholder. And frankly, a big opportunity is, can you spot the rising stars early that are in your backyard, be the person they want to talk to, and position yourself to grow with them?
So it's almost like you've got, I mean, if you think about in the technology, you got kind of like the startups and the big technology companies. So in terms of running your business, you're always keeping an eye on more of those younger, just getting started mining players
100%.
in the country. Okay. There are some bigger questions within the industry as well, which kind of dovetail with both of what you're saying, Canadian champions and international risk. We have a situation with First Quantum. I know it's another company, but it is an unresolved matter right now. May I ask how you've been viewing the situation that First Quantum is dealing with?
Well, it's tough. I mean, they're smart people. They're hardworking people. It's a great asset. When you, and I've been in this business a long time.
Yeah.
When you go into a country and you are extracting what they feel are their resources that God put in the ground for them, you can't be naive. I'm not suggesting they are for a moment. They're very smart people, but this type of stuff happens, and it comes with the territory.
Yeah, well, and it just highlights the things you have to navigate within your industry. Mark, it's good to have you back with us. Thanks very much for the candid comments this morning.
Thank you very much, John.